All right, we are looking at futures that are down, but potentially we have triggered a technical signal that means we're going to rally over 6 and 12 months. 30 minutes till the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Chinnock Bassick is off today, and Bloomberg open interest starts right now.
Coming up, mixed messages on trade. China denies talks again, contrary to what President Trump says. And Google is gaining on strong results, setting the tone for next week's Mag 7 reports. Plus earnings, tariffs, volatility. We're going to round all of that up, as well as the Zweig Breadth Thrust with Rob Arnott investing legend. Katie?
Meanwhile, some stocks we're keeping an eye on. Alphabet rising after topping earnings estimates driven by strength in Google's search business. You can see shares up about 3.4%, Matt.
All right, Intel is falling after the CEO announced those job cuts we've been reporting and a shakeup for the company's culture. All signs of short-term stress for the firm.
You can see shares down about 7% right now, but let's get to the latest trade developments because President Trump told Time magazine that he should announce trade deals in the next 3 to 4 weeks. That comes as China considers suspending its 125% tariffs on some U.S. imports, including medical equipment and some industrial chemicals. Bloomberg's Tyler Kendall has the latest. And Tyler, just give us the lay of the land here because there is some question marks still remaining over whether these two countries are even talking. But if you read the tea leaves, it seems like there's some positive signs there.
Yeah, hey, Katie. A potential de-escalation. Bloomberg News reporting that this would really focus in on those certain sectors where Beijing is more import reliant in a bid to protect their economy and shore up those industries that could be hit particularly hard. You mentioned their medical equipment, also industrial chemicals used to make things like plastics and cooling agents. Bloomberg News also reporting that potentially plane leases could see a reprieve as well. But at the same time, sources familiar do caution Bloomberg all of this is in flux as that disconnect between Beijing and Washington does appear to be continuing. Yesterday, you had President Trump in the Oval Office suggesting that talks with China were happening that day, even as Beijing denies that they are happening at all. And then in that Time magazine interview released today, but actually conducted on Tuesday, President Trump suggested that Xi Jinping has called him. However, he didn't give us any specifics on what was discussed or even when the timeline was. And it's probably worth mentioning that, of course, these leaders have had calls before in the past. Most recently that we know of is right before the inauguration. Matt and Katie, while we try to parse through whether or not these talks really are happening and what they potentially do contain, we can say there is a Chinese delegation here in Washington this week for the IMF spring meetings, but at this point, no formal bilateral talks have been announced.
Has it not gone beyond a suggestion, Tyler? Didn't President Trump answer in the affirmative when asked if Xi Jinping had called him?
Yes, he did. He said that he had called him, but he didn't give us those firm timelines on when that call had happened. And earlier this week in the Oval Office, when asked if talks with China were active, he responded that, quote, everything is active. So he is saying here that that call did happen. He also said that he would not call Xi Jinping directly if the Chinese president wasn't the one to call him first. But definitely still some ambiguity here on exactly how these talks are happening and at what level, because Bloomberg News had been reporting that Beijing had some important preconditions here, including that somebody other than President Trump be the point person to lead any trade negotiations.
A fluid situation, to say the least. Bloomberg's Tyler Kendall at the White House staying on top of all of it. But let's switch gears now to tech, because it's a tale of two earnings for Alphabet and for Intel. You have Alphabet posting a strong quarter thanks to search and its ad business, while Intel posts a bleak outlook. We also have Apple in the news after reports that the company is looking to build more iPhones in the U.S. Here to look at all things tech is B-Tech co-host Caroline Hyde. There's a lot to get to, but I want to start with Alphabet, up about 3.6% right now in the pre-market. It seems like the consensus from the sell side is that this was better than feared.
Phew, is what the consensus is. And actually, advertising revenue really resilient, considering that retailers, for example, is what some analysts called out. The fact that they're still committed to spending on Google products is notable. Now, this is also a company that's managing to weave itself into the new AI age. AI overviews, we got from Sundar Pichai the call that basically got about 1.5 billion people coming per month to be using their search and with AI overviews too. They did miss ever so slightly on sales when it comes to the cloud, the growth narrative within Alphabet, but the profitability was strong there. So that showed some real gains. They're still managing to be investing infrastructure-wise, $75 billion as the capex that they're sticking to because they need to keep rolling out. Once again, they're limited by supply on compute rather than by demand. And YouTube, look, we saw a slight miss in terms of the overall revenue for YouTube. But again, they're calling out numbers like 1 billion people coming for podcasts on YouTube per month. That's much more than Spotify and Apple. So overall resiliency coming from Alphabet, I think.
I hope they're listening to my podcast, Hot Pursuit with Hannah Elliott.
Who doesn't? Who doesn't?
Yeah. If you care about cars and motorcycles, you will listen to Hot Pursuit. I want to ask about Apple because Dan Ives recently said they build more than 90% of their smartphones in China. And now Apple plans to import, I guess, the lion's share of U.S. iPhones from India. So can it really move that quickly?
Unbelievable. They're going to be doubling, basically, their production in India in just a year. So up to fiscal March 2025, they basically were shipping about 40 million iPhones per year from India. Now they're going to make it 80 million. Here in the US, we import about 60 million. So they're going to be able to meet all of the demand. That's so important because at the moment, yes, smartphones and electronics have been stripped out of all these tariffs, but India faces far less hurdles than China does eventually. And so I think everyone's thinking, okay, we've got to redistribute. India has taken, remember, about a decade for them to get their manufacturing to where they need it to be, but we're managing to pull out all the stops and they're really accelerating that shift, Matt. You're so right.
All right, Caroline, thanks very much. Caroline Hyde there talking to us about the tech stuff because she's an expert, because she anchors Bloomberg Tech. It starts at 11 a.m. Definitely tune in for that. Let's get more right now on Google. For that, we're joined by Laura Martin, Needham analyst. She has a buy rating on the stock with a $178 price target. And I want to talk first about these AI overviews, Laura, that Google is doing. I guess it doesn't matter to me so much whether they're slightly successful or not, because they can't ever be as successful with that as they can with search, can they? They absolutely dominate in search.
So, good question. What they're saying is that the monetization is equal to their search. So what's getting hurt is you used to have links, and that would actually drive traffic to off Google site websites, and that's ended because now you're just getting your answers from AI Overview, that product. So Google isn't injured because it's getting the same monetization as it used to get with search, and they do have 1.5 billion users. So you're right, from the point of Gemini, which is their generative AI product, which is sort of different from Google Search or from AI Overview, they are way behind ChatGPT over at OpenAI. But in terms of Google Search, it seems like they're elongating engagement, equaling the monetization, and they've now got 1 billion people globally in 140 countries essentially using their search engine, but it has answers now instead of links.
Laura, I also want to talk about the ripple effect that we're seeing from this report from Alphabet, because you have the likes of Meta and Reddit, some of the other social media names up today. You wrote about this in your reaction piece. Basically, we heard from the CRO that they haven't necessarily seen a slowdown in ad demand during April yet as a result of the tariffs. Do you think that's a sustainable situation?
I mean, good question. Technically, tariffs doesn't affect these virtual companies, but what affects them is consumer demand and consumer sentiment. So we need to keep a close eye on what's happening with consumer spending. And in some cases like retail, I think the market was really pleasantly surprised to hear that Google had said that in the second quarter, they haven't seen big deviations from the first quarter. And they called out retail as one of their 2 strongest ad drivers in the first quarter. So if that hasn't changed, that's a big surprise, because you would have thought, or the worst case would have been that advertisers who are seeing tariff increases in retail would immediately cut their ad spending in order to hit their promise of earnings to their CEO. So if that's not happening, that's a good sign that the enterprise isn't slowing their ad budgets and that consumers haven't stopped buying goods.
I keep listening to reports on Google, reports on Alphabet, and usually in the second half of the discussion, they talk about a breakup. But it's shocking to me because if you're talking about the potential breakup, you know, I grew up during the breakup of Ma Bell. I would think that takes the lead. Why is this so buried, Laura?
So, for one thing, they didn't talk about it on the call. None of the 2 lawsuits they've lost got discussed on the call, and no analyst asked about it. So I think a reasonable question to this management team would have been, look, if they force you to spin off the ad tech business or spin off Chrome, or what does Google do? I think that's a reasonable question. Nobody brought it up. The other thing I'd say is all of our work shows that this stock would rise 20% if they were forced or just decided to sell all or part of YouTube.
Wow.
Because a lot of the assets here are a lot more valuable standalone than they are as part of this conglomerate because it's undermanaged. I mean, I think the market is telling you it is 17 times to 2025 earnings per share, which is half the market average. They do not like this management team.
That is really interesting. I just want to meditate on that point a little bit more. So you're saying if they spun out YouTube, basically, that could drive 20% upside in the shares. I mean, do you see that as a possibility? Are there any tea leaves to read there that could be something that happens?
So good question. I think so. That's a good question. I think the government is talking already about spinning off their ad tech business and Chrome. The point we're making with YouTube is that this company is worth more in pieces than it is together, in my opinion.
All right, Laura, really interesting note to end on. Hope to have you back soon. That is Laura Martin of Needham. Now coming up, Rob Arnott of Research Affiliates joins us at the desk. This is Open Interest.
Let's get to high interest now. Look at what's making headlines around the world. First off, a Bloomberg scoop. It's a deal that would rank among the biggest buyouts ever. Toyota Motor Chairman Akio Toyoda is proposing to buy out Toyota Industries, and the move would consolidate the chairman's grip on Japan's biggest business empire. Toyota Industries famously makes textile looms, as well as parts for Toyota's cars, and discussions are ongoing. Foreign investors have sold $63 billion of U.S. equities since the start of March, according to a Goldman Sachs estimate. The data from high-frequency fund flows shows that European investors have been driving the selling. Goldman notes that since 1980, there have been 10 other instances of substantial foreign investor selling. And it's been quite a week here in the U.S. The S&P 500 has risen more than 1.5% on the last 3 consecutive days. This is an uncommon event that usually precedes bull runs. The question is, what happens on the 4th day? And according to our London-based charts producer, Dan Curtis, who incidentally is an Olympics-level rower, equities fall over 60% of the time on the 4th day. So don't hold your breath today. And by the way, speaking of silly technical indicators, I am super pumped on the Zweig Breadth Thrust. This means that if you see positive breadth going from 40% to 62% over a 10-day period on the NYSE, 6 months out, you get a double-digit gain. 12 months out, an even bigger double-digit gain. I think the average is 24%. And we've only listed a few of the occasions here. This signal has been triggered 19 times since World War II, and the market has finished up 6 months out and 12 months out each of those 19 times. So, Katie, it's 100% for the Zweig Breadth Thrust.
Incredible setup, Matt Miller. Let's discuss this with Research Affiliates Chairman and founder Rob Arnott. Rob, it's great to see you on this Friday.
Great to see you.
So Matt's psyched, and he's not alone when it comes to the Zweig Breadth
I got dressed
Thrust.
in the dark.
He came
because
over
of this.
to my desk at 8:47, basically hooting and hollering about this thing. So tell me how you're taking in some of these signals. There's a lot of people also on social media and in notes this morning who are jazzed about it. But at this moment in the markets, how much stock can you put in technical indicators such as that one?
I forget who it was who coined the expression, but if you torture the data long enough, it'll confess to anything. If you mine data and look for predictive relationships that have a great batting average in the past, you'll find a gazillion of them. I think that's the technical mathematical term. And most of them will be nonsense. This one, my confidence in it is about the same as tea leaves or sunspots.
Some people have a lot of confidence in those. I will just note that last time you were here, we talked about dead cats and then bouncing. Now we're talking about torturing data, so it's always a violent
this is
conversation.
a dark, dark
Yeah.
conversation.
Let's talk about something in which you have a little bit more confidence, and that is when we get these periods of high volatility, you see investors shifting into lower risk stocks, diversifying their portfolios, and looking for value stocks. How's the best way to define that? Is it value by PE? Is it value by price to book? Is there any kind of consistency measure? How do you define that?
Well, firstly, we like to use multiple measures. We like to look at relative price to earnings, price to cash flow, price to book, price to sales, price to dividends plus buybacks. And using multiple measures is a much richer picture. But
a blended.
Right. But
picture,
the relatively simple ways that Russell, for instance, bifurcates between growth and value are perfectly adequate. So what we find is that periods of turbulence lead to a flight to safety. Periods of elevated inflation lead to a flight to safety. And we're in a very special environment in which value is extraordinarily cheap relative to growth, fueled in part by the surge of money into indexation, which pushes the expensive up and the cheap down. But you have value extraordinarily cheap. You have a possibility of renewed inflation, perhaps on the back of tariffs. I can come back to some observations on that in a minute. And in addition to that, you've got heightened volatility.
Well, just meditating on that a little bit, what you're saying that you look at value, it's historically cheap to growth. I feel like you could have said that, oh, it looks like we are actually going to hear from the president.
President Trump is talking. We have to listen. Let's tune in.
It's going to be very interesting. We're going to meet with a lot of the foreign leaders. They want to meet. Trade deals are going very well. I think Russia and Ukraine, I think they're coming along, we hope. Very fragile. And Iran, I think, is going very well. We'll see what happens. We're working on plenty of things that shouldn't be worked on because none of this stuff should have happened. This should have been taken place by Biden. It should have been fixed by Biden, but he couldn't do it, nor could he come close to doing. So anyway, we're going to Rome to pay our respects, and we'll be leaving that same day. We'll be coming back home tomorrow night. And I'll see some of you over there. Otherwise, I'll see you on television.
How was the Witkoff meeting this morning? You said you spoke with President Xi. Have you spoken to him since the tariffs? When did you last speak?
I don't want to comment on that, but I've spoken to him many times. Yeah. From Japan? From Japan, I'm getting along very well with Japan. We're very close to a deal.
Will you be meeting with the President?
I'll be meeting with the Italian. Yes. Your Prime Minister? Oh, it's possible.
How would you the First Lady remember Pope Francis, sir? How would you the First
Very well. Good man. He loved the world, actually, and he was just a good man. I met him twice. I thought he was a fantastic kind of a guy.
Time magazine that President Xi called you. When did that happen, and what did you discuss?
I'll let you know at the appropriate time. Let's see if we can make a deal.
The Witkoff-Putin meeting. Any updates on the Witkoff-Putin meeting, sir? The meeting right now. What do you hope to see transpire?
They're meeting with Putin right now as we speak, and we have a lot of things going on. And I think in the end we're going to end up with a lot of good deals, including tariff deals and trade deals. We're going to make our country rich. But we're going to try and get out of war so that we can save 5,000 people a week. And that's what my aim is. I want to save 5,000 young men. They happen to be mostly Ukrainian, Russian. 5,000 young Ukrainian and Russian men. And that's a big honor if I can do it. I think we're pretty close. No deadline. I just want to do it as fast as possible. What?
12 states have sued over your tariff plan. What do you say to those who voted for you?
I think the tariff plan is doing very well. We're resetting the table. We're going to make our country very rich, very, very rich. It's already happening. Thank you very much.
And that was playback of President Donald Trump speaking to reporters moments ago. Let's bring back in Rob Arnott. So, Rob, we play this because this is what markets are moving on, trying to basically divine what is going to happen with our trade relationships with the rest of the world. And it almost feels impossible to try to model out what the impact will be on earnings, on businesses, on the economy. And I wonder, as an investor, how are you approaching the whiplash when it comes to the state of negotiations with China, with Japan?
George Box famously said that all models are wrong, some models are useful. I find it hilarious that Wall Street keeps trying to model tariff impacts on inflation, on GDP, on interest rates, when the tariffs change every single day. Relatively easy to model volatility. What's going to happen on the trade negotiations, on the tariffs? None of us knows, and I don't think even Trump knows. It's a game of high-stakes chicken. And so the way this plays out, with relatively high confidence, we can say it plays out in a context of elevated volatility. Well, what happens when you have elevated volatility? The natural level of markets goes down because of risk aversion. The relative performance of growth tends to get hit harder because people are seeking the safety of basically a safe haven, a margin of safety. And in the quest for that margin of safety, risk-off assets tend to do reasonably well, and value tends to do well relative to growth. You also have disruptions that take perfectly reasonably priced markets cheaper. Small cap value has gone from cheap to a little cheaper. Well, that's a buying opportunity. And human nature conditions us to say, get me out of here when something is disappointing. The correct response is, has anything changed on the fundamentals? If not, take advantage of the bargain.
Interesting. Well, that's where I want to go. I mean, small cap value, that is not for the faint of heart. No. And as you point out in your notes, it's been hit really hard over the past couple of weeks, months. So the fundamentals haven't changed, but
no, they haven't.
Still, do you need a catalyst for folks to actually be brave enough to step in?
The catalyst often is that it's already made a move and you've missed it.
Yeah. That's what I wonder about, the timing especially, right?
Average in. Average in.
The Russell 1000 value index is down 2.5% year to date. The growth index is down well over 10% year to date. I looked at this because I was looking at the S&P over 2001, 2002, right?
Yes.
3 years in a row of declines. And I was thinking, well, if at the end of 2000 you said, I'm going into value stocks, you still took huge losses the next year. The Russell 1000 value index was up in 2000, but then down 7% in 2001 and down 17% in 2002. So the timing matters.
Right, right. But a lot of that, relative to the S&P and relative to NASDAQ, was a small hit. One of the things I found fascinating is dot-com bubble burst in March of 2000. Roll the clock forward 2 years to March of 2002. NASDAQ was down roughly 50% on its way to a 78% drop.
Ouch.
And
took
Russell,
20 years to recover.
Right. And Russell 2000 value was up 53%. So small cap value, despite its feeling risky, actually left you 3 times as wealthy as a NASDAQ investor in just 2 years.
There you go. That is a good place to put a pin in this conversation. Rob, you're sticking with us through the opening bell. Coming up in just a couple of minutes, and here is your setup as we head into 9:30. You can see the S&P 500, we're pretty much unchanged. We're coming off of a couple days of pretty sizable gains, as Matt led us through a couple of minutes ago. But right now, a little bit of a break. Same too when you take a look at big tech. Even though you had those good numbers from Alphabet last night, not really putting much of a bid into the NASDAQ 100 overall, and those small caps, as we were just talking about, small caps overall, as measured by the Russell 2000 right now, Matt, currently down about 0.8%. We will bring you all of the opening action up
Did you
next.
notice the Dow?
Tell me about the Dow.
Back up through 40,000. You didn't get that memo yesterday? The Dow Jones Industrial Average, the index that probably most living people recognize more than any other.
We're going to talk about the Dow, the S&P 500, the NASDAQ 100 up next. This is Open Interest.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We have had 3 consecutive days of whopping gains, adding more than 300 points to the S&P 500. Maybe today is time for a breather. You can see the S&P 500 is unchanged even after good earnings from Google. In fact, most of the earnings that we've seen yesterday and this morning have beaten, certainly on the EPS, on the bottom line, if not on sales. Okay, we're flipping up to slightly positive there, but this is still futures. Let's take a look at the bell. First of all, it's the Arbor Day Foundation ringing the bell at the New York Stock Exchange, which is great because the whole thing started around a buttonwood tree in 1792, right? So going back to their roots, so to speak, no pun intended. Down at the NASDAQ, you have Merex ringing the opening bell. Their stock has more than doubled over the past 5 years, so they have good reason to be happy. And maybe everyone's psyched because the Zweig Breadth Thrust Indicator has been triggered, Katie, and 19 out of 19 times since 1943. That means gains 6 to 12 months out.
I will note that the yield curve had a great recession track record, and it worked until it didn't.
And the SOM rule.
We'll continue to talk about that, but let's take a look at the stocks that are making the biggest moves at the opening bell. We start, of course, with Alphabet. As Matt mentioned, it topped earnings estimates. It was driven by strength in the Google search business. Shares up about 3%, so a needed dose of good news here for this stock. I will note that Alphabet was down nearly 16% year to date through yesterday's close, Matt.
All right, so we see the moves there in Google. I want to point out also Intel moves to the downside 9% after the CEO announced job cuts. Bloomberg's been reporting for a week or so, but job cuts and a shakeup for the company's culture. He struck a very somber tone about what's going on at Intel, and as a result, the stock has pretty much been decimated today in the early minutes of trading. We are back with Research Affiliates Chairman and Founder Rob Arnott. And Rob, I'm so fascinated by this, not just the value play that you recommend, but also the small cap value. And I wonder, because I think of small caps as not profitable. I mean, a huge part, right, of the Russell 2000 is not profitable. And I guess you have to be a value stock, you have to have an E, right? If you're measuring PE.
If you're going to survive, it's useful to have an E.
Is there any way, do you measure consistency when looking at value stocks? I mean,
I tend to look at them in aggregate, but I also like to use quality filters. Look at the profitability, look at the debt equity ratio, look at the debt coverage ratios, filter out the possible value traps. We have quality filters that I like to joke eliminate 10 out of every 3 value traps. For every 3 that go bust, you're filtering out 10. But it winds up being a very useful way to make sure that the value investments that you're buying aren't merely looking cheap on their way to zero.
Your thesis makes total sense to me, that in times of trouble, people gravitate towards something that's safer, that's more, that's less risky. But on the other hand, you also point out that those frothy stocks, airy frothy, get sold off. And I was just wondering, do you prefer long investing versus short because your losses could be capped? Is it also inherently less risky?
I'm okay with long short, where you're long some stocks and short others, but shorting a bubble is really dangerous. My favorite example is the Zimbabwe stock market in 2008. They had hyperinflation underway. At the start of the summer, the currency was in free fall. Somebody could have looked at that and said, this country's in trouble, I want to short the stock market. Well, the stock market in the first 8 weeks of summer went up 500-fold in Zimbabwe dollar terms.
Ouch.
The currency fell 10-fold, so in US dollar terms it was up 50-fold. If you had a 2% short position, you just got wiped out. The next 6 weeks, the currency fell another 100-fold in 6 weeks, and the stock market cratered and stopped trading. And so you would have been right but bankrupt. Minor problem.
Right, but bankrupt. I would rather be wrong and rich. But let's talk about international a little bit more. Maybe not Zimbabwe, some painful history lessons there. But when it comes to this international theme that's really percolating around markets, you have a lot of folks talking about selling American assets and just going international. Where do you fall on that narrative?
I think non-U.S. markets are cheap. You look at The U.S., we came into the year at a Shiller PE ratio of 37. We're still at 34. We had the Shiller PE ratio is price relative to 10-year average earnings. It takes out the effects of economic peaks and troughs. And Europe was 18 times. Emerging markets was 15 times. These are cheap. And of course, Europe has soundly outpaced the U.S. year to date. So what's cheap gives you that margin of safety, even if it doesn't feel like it.
So if international markets are cheap overall, I have to imagine that small cap international is pretty cheap as well.
Small cap international is cheap. Small cap and emerging markets, not so much. And value international is historically cheap. Value in emerging markets is near record cheapness. U.S. value relative to growth is near record cheapness. Small cap relative to large cap in the U.S. is near record cheapness. These are cheap markets. 2 years after the dot-com bubble burst, an investment in Russell 2000 value left you 3 times as rich as an investment in NASDAQ. I wouldn't be shocked if, at least directionally, we find a similar thing play out in the coming couple of years. I don't think it'll be a 3x multiple, but who knows?
All right, we'll have to check in with you on that. I've restrained myself long enough. I really want to talk about ETFs. I was explaining to Matt this morning at 6 in the morning that you recently have made some hay by shorting triple leveraged ETFs, both on the long and the inverse side, because if you hold these products for long enough, because of the volatility drag, because of the financing costs, they tend to underperform over time. And it's interesting, since I wrote that article about you on that trade, you saw Defiance, an ETF issuer, come out and file for a double short MicroStrategy ETF. It would hold a leveraged MicroStrategy ETF, but shorted. And Rob, I'm so curious to hear your thoughts on whether this trade can still work if you put it in the ETF wrapper.
By the way, I love this.
Yeah.
When Katie explained this to me, like a light bulb went off. And
Yeah.
I absolutely adore the idea, because these are products that are meant to be used for a few hours or a few days at most. The idea that you short them over time, I think, is fascinating.
There's so much interesting about these triple leveraged and double leveraged ETFs. Firstly, put it in an ETF wrapper. Sure, why not? The issue is capacity. Right. I'm doing this on a $5 million scale, and the borrowing cost to borrow ETFs, triple leveraged ETFs, is astonishing. Typically, you're looking at 10 to 20% borrowing costs per annum.
Yeah.
Silver, there's a 3x levered silver ETF, long and short. You short both of them, you cancel the risk. Very cool. And you capture the volatility drag. But to short the short ETF, your borrowing cost is 7,000 basis points a year.
Ouch.
So now, I was shocked. I did that one on a very small scale, and I was shocked I made money net of the 7,000 basis point cost. But that's a daunting cost. Now, put this into an ETF, and kudos to the folks launching the ETF. It's a clever idea. On paper, it'll work beautifully. I worry. I'm doing it on a $5 million scale, and the costs are insane.
Yeah.
Try it. Let's say that 50 million flows into the fund. Just 50 million. I think you'd swamp the market.
Yeah.
Imagine $250 million flows into the fund. You'd demolish the market.
Yeah, and that's not out of the realm of possibility, because we've seen so much investor appetite for these leveraged products. So just to tie a bow on this point, so basically if these get any sort of meaningful scale, the trade ceases to work because the borrowing costs are going to skyrocket.
Correct. There's another fascinating nuance of triple leveraged ETFs, and that is if the market goes up, they have to buy in huge margin, in huge quantity, the asset that they are shorting or going long leverage. And the reason behind that is if you're triple leveraged long and it's up, you're now under levered and you have to buy more. If you're triple leveraged short, you're now over levered and you have to buy. So if the market that you're shorting or going long 3x levered goes up 10%, the combination of the two ETFs has to buy over 100%, over 100% of their total AUM on that day.
You got to stop telling people about this stuff, Rob, because then Katie writes about it and she blows up your spot, right? Because then your $5 million trade gets ruined by somebody coming to the market with size.
It's a game, and the game is coming to an end.
It was fun while it lasted, though.
But, you know, somebody's launching an ETF on it, so it's out there.
There you
Rob,
go.
awesome to have you spend some time with us. Thank you so much for coming in. Research Affiliates Chairman and Founder Rob Arnott. Let's talk about some of the movers on our radar today. Skechers is a shoemaker. You may know the brand, and it is the latest to pull its annual guidance. So Skechers down 3.4%. It is a kind of a down-ish
They have
day
the light up sneakers
right
though,
now.
So.
We have T-Mobile missing on subscriber additions. As we know, some have missed, some have hit in terms of the big two. T-Mobile in the former category. And then Colgate cuts sales and profit view on a $200 million tariff hit. I understand the sales, but in profit, I mean, do you have any choice but to buy toothpaste?
That's the thing. You would imagine that they have some pricing power when it comes to their very staple-like products, but it'll be interesting to see how that story develops. Meanwhile, coming up, Morgan Stanley's Jitania Kandhari on the Sell America trade. We'll discuss next. This is Open Interest. All right, welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Hasbro getting upgraded to a buy over at Citi thanks to its underlying business momentum. The toy maker beat analyst estimates yesterday. Also said it's in good shape to weather the tariff increases. Shares up about 0.8%. Next up, we have Lowe's getting upgraded over at KeyBank along with its peers Williams-Sonoma and La-Z-Boy. The analyst says that the recent pullback creates opportunities, pulling back a little bit more today. And finally, we have UBS upgrading Philip Morris to neutral as it sees strength in the tobacco company's smoke-free gross margins. Shares pretty much unchanged. Speaking of unchanged, let's take a look at the stock market right now. The S&P 500 almost perfectly even on the day. Now, there you can see it, even if this holds, even if the S&P 500 doesn't do anything today, it's still higher by about 3.8% on a weekly basis. A lot of people will take that in this market. Similar story if you take a look at the NASDAQ 100, unchanged despite a beat on Alphabet, but the small caps really taking a beating right now. Matt Miller down about 0.7%.
I'm kind of bummed out right now.
No.
My bubble has been burst because Simon White from the Markets Live team at Bloomberg in London has told me the Zweig Breadth Thrust Indicator was triggered in August of 2008. And that means its perfect record is ruined. 6 months out, it was down big. 12 months out, it was still down.
19 out of 20 isn't bad, Matt.
True, 19 out of 20. Let's talk about these crazy markets with Jitania Kandhari. She's the Deputy CIO of Solutions and Multi-Asset at Morgan Stanley Investment Management. Jitania, thank you so much for coming in and joining us here on set. We've had a string of up days, 3 in a row, and that only happens like once every 5 years. We have a chart. We have a chart of this, and you'll see how rare it is.
We'll show it in about a minute.
Was that a head fake? I mean, or have we put in a bottom in this market?
$1 million question. I think we really have to see how the trade negotiations pan out. I was in DC recently, and it seems like we are at peak trade uncertainty. So from here, I think the marginal incremental news gets slightly positive. Section 232, which is pharmaceuticals and minerals, are still being contemplated and thought about. But I think if there are some bilateral deals struck, the ones that look obvious are Korea and India, maybe UK. There may be some respite in the market, but I think the longer term issues of where the earnings and margins settle is still a question.
And there we have
Here's the
chart.
chart.
as you can see, pretty rare to see these types of gains. But it's interesting to hear what you're saying, that any sort of incremental positive news will probably send this market higher. Talk to us a little bit more, though, about the mood music at these IMF meetings. I mean, what did the conversations on the ground actually sound like?
Too much consensus, which is interesting. Worries about U.S. growth, worries about U.S. earnings, worries about the dollar, and diversification into gold and cash. So I think consensus has really swung to that direction. So it's important to keep in mind. Even some of our dollar charts are indicating positioning in the yen has reached pretty extreme levels. So I think you could expect a bounce back, especially if there is some positive announcement. But I think over the longer term, I would question the margin sustainability in the market, because a lot of that margin improvement that has happened in the U.S. markets has been on account of globalization, which is now turning. So I would be worried from a longer term perspective on where those earnings are and what market multiples are assigned to that earnings. So I think longer term, there is still some room to expect more correction.
Are we at the point yet, Jitania, where everything we've learned about finance, economics, and markets is now meaningless? Like, is this an absolute sea change in global trade? Will the dollar remain the world reserve currency? Do you still buy treasuries in times of fear?
Yeah, I think there's one thing where there's a sea change. The dollar, which is the reserve currency of the world, gives it distinct advantages. But with those advantages, it gives it a responsibility to act and preserve economic resilience and trust in the international community. And that is being questioned with the interference in central bank, with the interference in institutions, and that's what the US stood for. So I think economics is working, right? Fiscal monetary policy in the US is constrained, and that's going to also have an impact on growth. Fiscal and monetary policy in the rest of the world is much better, and that's why the markets are pricing in better outcomes in other pockets of the world. So I think economics is working. There's a regime change in the credibility of the dollar and what that means for institutional trust and stability. And I think that is something that is important to keep in mind, because it's reflecting in the term premium in treasuries. So we are watching that. My hope is that, we've reached like the peak fear situation, but something to really keep a close eye on.
We have 30 seconds left, but that's a really big point, so I want to just meditate on it for a minute here. Is that investable yet? You said you're keeping an eye on it, the dollar's credibility as the reserve currency. Can you invest in that yet?
I think diversification, you cannot get out of the dollar because it's still a large part of the financial system in terms of reserves, in terms of debt, in terms of transactions. But I think diversifying out of the US is making much more sense because, as I mentioned, the monetary policy, fiscal policy is better in different pockets of the world. ECB cut, India cut, Philippines cut. That's one. And I think the currency valuations for the rest of the world, it's very heterogeneous, so you really have to be active, can be a very strong component of total returns for international markets. I've always said that currencies can contribute to a third of returns. And that's an important tailwind for international.
All right, Jitania, have to leave it there. Hope to have you back soon. That is Morgan Stanley Investment Management's Jitania Kandhari on a potential sea change. Now, coming up, we'll dig into those Alphabet results a little bit more in Open Interest. This is Bloomberg. Welcome back to Open Interest. A check on Alphabet, higher this morning on strong ad revenue. For more on Alphabet and all things tech, I'm pleased to say we're joined by Mandeep Singh of Bloomberg Intelligence. So Mandeep, when we spoke to you yesterday about Alphabet for a preview, you said that you were still a little bit worried about the fundamentals here. Give us an update now that you've had time to digest from what we heard last night.
Yeah, I mean, look, for a company like Alphabet, they can pull a lot of margin levers, and that's exactly what they showed last night. The search margins grew even though the top line didn't grow that much. And what it shows is the search franchise is still intact. Look, their Gen AI results may not be superior to ChatGPT right now, but they still are adequate for a lot of the search users, which is pretty much the entire planet, when it comes to the traditional search. So net, look, they have diversified their business, cloud, YouTube, Waymo, but the search franchise, I think, is intact, and that's what they comforted the investors last night.
Mandeep, I keep seeing in Google stories on like page 4 that they may be broken up by the U.S. government. Why isn't that the lead?
Well, I mean, there are a couple of pending cases, the monopolization and the ad tech, and there could be remedies that come out of it. But there is no denying the fact that Google has more competition now than it did, 2-3 years back. So from that perspective, if you're looking forward, I think it may be hard to come up with a remedy that involves divesting a business because they have a monopoly. And look, it has hurt them in terms of flexing their muscle when it comes to the ad integration they can show across the apps. But overall, I think they are showing that, diversification is helping their business. The cloud side will be a driver in the second half, regardless of what happens with the de minimis change, which will be a headwind. I mean, they called out softer 2Q and the fact that Chinese advertisers are pulling back. So I think they have multiple levers. Even if something were to happen on the regulatory side, they should be fine.
All right, Mandeep, thanks very much. Mandeep Singh there of Bloomberg Intelligence. Coming up in the next hour, Citi's Kate Moore joins us at the desk. Plus, we speak to the CEO of a major food group and Ducati North America. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off today, and coming up, stocks pausing their three-day rally as the U.S. and China sent mixed messages on trade talks. Meanwhile, you have Alphabet setting the tone for tech earnings, beating on revenue and profit expectations. Plus, we'll speak with the Ducati North America CEO about how tariffs are affecting the motorcycle business. That certainly matters for one Matt Miller. And dirt bikes. All that and more coming up. But we do have some data crossing the wire right now. University of Michigan sentiment, the final read for April, dropping right now, coming in at 52.2. That is slightly higher than what we got when it comes to the prior read of 50.8. What's interesting and what we should be paying attention to are the inflation expectations. 1 year inflation expectations coming in at 6.5%. That is slightly lower than what we got previously of 6.7%. And then you take a look at the 5 to 10 year inflation figures, though, Matt. This might be concerning, still unchanged at 4.4%. Bang in line, not making too much of a dent in the market. But when these preliminary figures came out and that long-term inflation expectation came out at 4.4%, it certainly sent some shudders through risk assets.
Yeah, but all in all, pretty boring numbers for the University of Michigan when they have previously moved markets pretty substantially. Yeah. And it is, like, the trade looks pretty boring, but it is an exciting day because A, it's Friday.
It is, thank goodness.
B, we've had 3 days of more than 1.5% gains, which only happens like every 5 years.
That's true.
And Kate Moore is here.
She's actually sitting right to my left. Yeah. Should we get to her?
I'm excited.
Let's do it. All right, Kate Moore, she is Citi Wealth Chief Investment Officer. Talk to us about where we are in this market. I think it's a real sign of the time that I'm even breaking the final numbers on the University of Michigan, because usually we just break the preliminary and then we put it away. But where are we in the cycle, this market cycle, when we're taking a look at every single incremental headline and data point?
Yeah, and we're all obsessing about the soft data. Like every survey, every measure of consumer or business confidence is having kind of outsized impact on market moves. And of course, we are in a market where we're trading on feelings and not always facts. And I would say this is particularly true as we've been whipsawed by all of these headlines over the course of this last week. Yes, Matt, you're right. We've had these 3 consecutive days of 1.5% gains in the market. I would tell you that it's not a gain or a sustained period where people feel good about the market move. There's a lot of short covering, a lot of rebalancing, but in general, the number of questions is still enormously high as we enter into kind of the rest of earnings season.
We did have the Zweig Breadth Thrust Indicator triggered, which we now know has been a positive indicator 19 out of the last 20 times since World War II. So I'll get by that and go straight to the terrifying quote from Torsten Slok's most recent Daily Spark. He says, the consequence of this trade war will be empty shelves in U.S. stores in a few weeks and COVID-like shortages for consumers and their firms using Chinese products as intermediate goods. Anna Wong of Bloomberg Economics said something similar. And I think a lot of people out there are pretty terrified, right? University of Michigan sentiment figures be damned, about what's going to happen. Like, I was ready to buy a motorcycle last month, and I'm now putting that decision on hold because who knows, right?
Well, I went ahead and bought some extra running shoes as my running shoes of choice.
What brand?
I'm a Hoka girl.
Me too.
Yeah. They are manufactured in Vietnam and China. And I just wanted to make sure there would be no shortage as I kind of ramp up my mileage going into the summer. I mean, I'm joking, but I'm also not joking. I've seen a lot of this analysis, and of course, we were looking at the days of container ships to different ports, what that might mean if China had stopped shipping or if companies had stopped putting orders in anticipation of these tariffs. And we're all coming to the same conclusion, that there may be less goods on shelves at some point. We'll call it by Memorial Day. But we also know that a lot of businesses stocked up on inventory ahead of this sort of stop in shipping. And that was simply like a smart move. If you don't know what's going to happen in the future, go ahead and pull forward some of the demand, just as I've pulled forward my running shoe demand.
Yeah.
And let's wait it out.
Well, I minored in psychology, and this really feels like a really good case study here because I heard that you're pulling forward your purchase of running shoes. I'm thinking maybe I should go on Roadrunner Sports and buy my own pair. And it kind of feels like this is how it happens. This is how we talk ourselves into a recession.
Yeah, and then this bringing forward of demand, as you mentioned, the more we share these stories and these anecdotes, we've been doing it on our team, I've been doing it with clients, and we're all saying, we're going to make these purchases now and then go into a wait and see mode to really kind of gauge whether or not tariffs are going to impact our daily lives. I think companies are doing the same, and as we're listening to CFOs and CEOs report over the course of earnings season, this is definitely the message, which is, hey, nothing's wrong right now. By the way, we're trying to model some things or put contingency plans in place, but we are kind of pausing incremental spending. We are pausing incremental CapEx. We are pausing incremental hiring, and I think that pause is really going to hit over the course of the summer, unless there's a significant change in terms of sentiment and in terms of the trade situation.
Right. I mean, everything seems to be on hold. Yesterday, we were going through at least 10 earnings calls had a CEO say uncertainty.
Yeah.
And we've seen outlooks put on hold. But there's some things you can't pause. I mean, if you have, like a retail investor has a CD that has matured, right? And needs to put that money to work, what do you buy here?
Yeah. So an uncomfortable bit of advice that we've been giving to our clients, and of course that gets represented in our portfolios as well, is that now is not the time to add to risk. I've been saying this for the better part of the last 6 weeks or 8 weeks, as it turns out.
Great timing, by the way.
It was good timing, but an uncomfortable message because everyone wants to see, wants to know, is there something that's, trading at an attractive valuation or that has great long-term growth prospects that I should be taking advantage of, given this price volatility? And the answer is we have no visibility into future earnings growth really at this point. I expect earnings estimates to come down further, even though we've had some decent reports and solid earnings in the first quarter. And I expect economic growth, numbers to come down further, even if we reach some agreements on tariffs, because we know the trajectory of the economy is down. Doesn't have to be a sharp down, but was slowing ahead of any of these tariff announcements.
We are, by the way, more than a third into earnings season. We've beaten on sales by like 1%.
Yeah.
We've beaten on earnings by like 10% so far. So
it hasn't been
horrible.
bad. It hasn't been that bad, to Matt's point, but it just feels like it's the guidance that all anyone cares about
Totally.
because the numbers in the first quarter are stale at this point. And I want to talk a little bit about timelines here because you mentioned you wouldn't add to risk over the past 6 to 8 weeks. There was an interesting LinkedIn post from Wei Li of BlackRock, basically talking about some of the same things that Torsten Slok did. You think about the disruptions in the supply chain, but she took some solace and maybe a little bit of a walk back from President Trump on trade this week. And she said, this is why over a 6 to 12 month horizon, I am cautiously bullish. So maybe you wouldn't add risk now, but 6 to 12 months, how does that sound?
Well, let me address this whole point around sales and then earnings.
Yeah.
So the revenues and then the bottom line, because this is an important thing. I've always said, let's not bet against the resilience of companies. And we know that in tough situations, they will do what it takes to deliver on the bottom line. But they need some certainty about the environment in order to do that.
Mm-hmm.
So while I expect earnings to come down, I don't know that they're going to be catastrophic because especially the U.S. large caps and the mega caps with all of these geographically diverse sales and lots of different businesses and really sophisticated systems for shifting capital from one area to another can, weather difficult storms. So that's point number one. But I think the bigger challenge here, and this is something that we're really debating, is what happens to demand for even high-quality U.S. risk assets in an environment where we have so little visibility into policy and to economic growth. Mm-hmm. And it's not just a question that we, as maybe U.S.-based allocators, are thinking about, but Citi is a hugely global brand. Our clients are incredibly geographically diverse. And as a result, we have to ask ourselves, if I'm sitting in another area, would I be putting incremental money into U.S. assets at this point in time, given the fact that we are less than 100 days into this administration and there is no clarity and there is no consistency?
And the answer is no.
The answer is I'm going to hold off on putting more money into U.S. assets, even if they're high quality, even if these companies can deliver on the bottom line, even if spreads kind of stabilize where they are on the credit side.
All right, Kate, great having you here. I hope we
Thank
can
you.
get you back.
Yes.
I hope the answer changes to yes at some point. Kate Moore there of Citi Wealth. Let's take a look at some of the stocks that are moving this hour. Obviously, Google is one we've been keeping an eye on. It is the top gainer among the Mag 7 stocks. Not a huge gain, but up 3% because it had strong ad sales helping to drive revenue and profit above expectations. But Katie Greifeld,
yes,
your iconic American chip maker is another story.
Boy, just in the gutter when it comes to Intel, falling in a big way after new CEO Lip-Bu Tan gave investors a sense that it will take a while to fix the chip maker's problems, to put it mildly.
Dark outlook.
Yeah, this was his first earnings call as CEO of Intel, and you can see the reaction down 8% in shares.
There you see AbbVie climbing after the company released its profit outlook for the year on better than expected sales from newer autoimmune treatments, and that's a look at some of the stocks moving. We're going to talk about, I should say,
yeah,
it's my favorite motorcycle.
It's good to put that disclosure out there.
It's my favorite motorcycle maker. It's the team I root for in MotoGP. World champion for 3 years in a row. Jason Chinnock, the CEO of Ducati North America, joins us as tariff tensions make my favorite motorcycles potentially more expensive. Next, this is Bloomberg Open Interest. Let's get to high interest. Look at what's making headlines around the world. BYD is having a robust start to the year as it sees first quarter profits soar. The Chinese EV maker announcing net income jumped to $1.3 billion, surpassing estimates and beating Tesla on another key metric. Analysts expect little impact, though, from President Trump's auto tariffs, considering the company doesn't sell any cars in the U.S. Apple is trying to import most of the iPhones it sells in the U.S. from India by the end of next year. The move would accelerate Apple's shift beyond China as it tries to mitigate tariff risks. While China is still the tech giant's biggest production base by far, production in India is up 60% this year from last year. And President Trump says he expects to wrap up trade deals with U.S. partners looking for lower tariffs soon. He told Time magazine, quote, "I would say over the next 3 to 4 weeks and we're finished." But the president gave conflicting signals about the status of talks with China, even as Beijing has denied that negotiations between the world's two largest economies are taking place at all. let's get to a very important commodity for me. Ducati is taking its legendary bikes off-road. The reigning MotoGP world champions recently revealed their Desmo 450 MX. It is the first production motocross bike from the Bologna-based factory, and just won their first MXGP podium on that bike with Jeremy Sewer in Switzerland. The announcement, though, comes as global uncertainty strikes across industries, across sectors, hitting automotive especially hard. And joining us to talk about all that and more is Jason Chinnock, the CEO of Ducati North America. Jason, so great to have you here. Thanks so much for joining.
It's a pleasure, Matt.
I'm obviously a fan, right?
Yeah,
so
I
make it clear, just so everyone knows. I want to normally be very unbiased.
This is why you came to work today. I know.
Yes, it is why I didn't call in sick this morning. No, so it's awesome that you guys have this new dirt bike out, and I want to talk about that. Yeah. But my biggest worry is tariffs, right? As someone who I collect Ducati motorcycles, and are they going to cost 25% more now?
Well, it's a valid concern, and the short answer to that is no. Thankfully, right now, we're actually only subject to the 10%, which is through the 90-day pause that's out there. And even so, we're evaluating really what of that do we need to pass on. I mean, that's something that we're considering. We haven't taken any definitive decisions, but we also are sensitive to the fact that there is price elasticity with purchasers of motorcycles. The good thing is that so far, we've actually built a pretty good plan to be able to carry us through, let's say, some negotiation times over the next couple months, which will put us in a good position, hopefully by the end of the summer, to have a pretty clear idea of where we'll go.
So how much inventory have you got stateside now is my main question. Like, do you have the new Ducati X Diavel here in size? Do you have, a lot of multi-stratas, because I imagine that's probably your best seller? And how many of these dirt bikes have you got over here?
Well, that's a great question. And actually what we did is we anticipated that this challenge was coming. You'd have to be living under a rock to not see what was going to end up coming in the first quarter of this year. So as a result, we ended up working very closely with our team in Bologna for our production, which is done there in Italy, in order to ensure that we had basically as much as we could to satisfy the model year 25. And it put us in a great position so that basically the inventory that's in dealer showrooms right now and some limited backstock that we have here in the U.S. will be able to basically carry us, like I mentioned, through the summer. In terms of some of the new models, those are model year 26s, and while we've already announced pricing on them, we haven't confirmed what we're going to do with those bikes. Let's call it post-tariff scenario. But I anticipate that it's not going to be anything that's going to change the game for us. I mean, it's important that we maintain a momentum. We've got solid, steady growth right now this year, and not just from a matter of volumes, but also profit. And we don't want to erode that, and we don't want to lose the clients.
So not a game changer. I am curious what the conversation, if it exists, sounds like with the administration, because we've seen many auto company CEOs come to Washington, talk to the president and his staff.
Giorgia Meloni as well.
There you go. Are you actively lobbying in any capacity?
Yeah, actually, last week I was in D.C. Actually, 2 weeks ago I was in Washington, D.C. with the Motorcycle Industry Council, meeting with different representatives from both the House and the Senate to basically share really the impact that it has. And quite candidly, it's less on Ducati and it's more on Main Street. And I think of the dealer network that I have 133 dealers across North America. It's important people understand what impact it has on them and the jobs that they have locally. So that was my responsibility to share that. And as a result, we've seen, let's say, some positive feedback and response. And I could confidently say that I think we have a pretty comfortable direction going forward, although that changes quite regularly.
It'd be great if we get a motorcycle carve out. I wonder about the dirt bike specifically, because this is a new place for Ducati, but you're almost guaranteed to be successful. With Paolo Ciabatti leading the race effort, I'm sure you're going to be getting more podiums, taking home a lot of trophies. And it's important to Americans as well. Dirt biking, motocross is huge in America. Is it going to be your biggest market?
Absolutely. In fact, I anticipate this is about 50% of the global market will be the U.S. or North America specifically. And that, to me, is really important. I've been a big driver of this project because of that. Because not only does it, let's say, gives us the volumes, but it also changes the perception of the accessibility to our brand. There's an excellent article I read a few months ago about the heart to the American motorcycles is not what you think. And a lot of people think it's cruisers because of the dominant American brand out there. But really, most people start motorcycling riding dirt bikes.
Right.
And so, as we know, motorcycling is not rational. It's something we do because it's fun. We love it.
Yeah.
And you make that emotional connection. And off-road allows us to make that connection and make the brand accessible to other people.
So my question is, when you make a Panigale, it has to be made in Bologna, right? It's about the style as well as the racing. But a dirt bike, you could arguably assemble in the U.S. Have you thought about bringing any of that production over here?
Well, as you mentioned, it could be argued, but made in Italy is an important brand attribute. I mean, it's something that people, when they think of Ducati, they think of Italy. And you think of the things that are part of our values and style, sophistication, performance. We have people building our motorcycles that have been doing it for years, that have decades, that have that expertise that start from, let's say, the bottom up, and now they're building a Panigale. So I would say nothing is left off the table, because we have to make sure that our motorcycles are priced at the point where people can still access them. But we also need to make sure that we don't compromise our brand as well.
Jason, we don't have a lot of time left, but I want to get a bit existential, because I thought what you were saying about motorcycle riding, it's not rational, is really interesting. And I'm wondering how you bring new people into the sport, because you and Matt Miller are special breeds of cat. There is no way on earth I would let my husband ride a motorcycle. I ride horses, so I'm also not interested. But there's a lot of concerns about safety, and you see the stats and you can get yourself scared. And I would just wonder how you actually go about changing that narrative and bringing more people into the sport?
So that's another great question. I mean, our responsibility as Ducati is actually really to perpetuate safety and enjoyment as well, because you don't want to anesthetize the experience. You want people to enjoy it. But all of the technology that we develop when winning races, like on the level of MotoGP, actually that technology trickles right down to the end product and the end user. And so when it comes to things like traction control and anti-lock brakes and basically the stability to control of a motorcycle, the radar, exactly, it actually helps prevent blind spot detection. Those are the sorts of things that make the brand and make motorcycling more accessible to people, and hopefully alleviate some of those concerns that you would have. But quite candidly, it's not probably less safe than riding a horse.
Sure, so that is also not
horse riding can be dangerous. I will say that for me, it's a third thing. So for me, like Keanu, like Brad Pitt, like Josh Brolin and Matt Miller, it's therapy, right? I need to clear my head, to get right, to strike a balance. I need to ride a motorcycle.
Got to get on the open road.
And let's listen. The danger is something that's exciting as well.
Yeah.
I mean, it is a bit of an adrenaline. I probably, just like riding a horse, there's a certain amount of you being on a animal that is you can't control, yet you're trying to manage. I mean, like a motorcycling is actually probably much more controllable, but the thrill of that is really something that we all live for.
Fair enough.
It's a very good point. Jason, great having you in the studio. Thank you so much for joining us. Jason Chinnock there, CEO of Ducati of North America. Now let's get let's get you caught up on all things cars, and I talk about motorcycles a heck of a lot. In fact, Jason has been on this podcast with me. Check it out, Hot Pursuit with Hannah Elliott. You can download it at Bloomberg.com or on Spotify, on Apple Podcasts, wherever you get your podcasts. This is Bloomberg.
Welcome back to Open Interest. A quick breakdown of this market with the S&P 500 near session lows. You can see we only have 99 stocks in the green right now. Big tech trying to push higher. Tesla, Nvidia, Alphabet all higher right now, but it's not enough. Take a look at the sector breakdown. We have more red than we do green. Only 2 sectors out of 11 in the green right now. Communication services, consumer discretionary up there, but you take a look down at the bottom. Healthcare, consumer staples, materials dragging down this index. This is Open Interest.
President Trump says he expects to wrap up trade deals with U.S. partners looking for lower tariffs soon. He told Time magazine, quote, "I would say over the next 3 to 4 weeks, and we're finished." Let's get the latest now from Bloomberg's Tyler Kendall in Washington. So, Tyler, which trade partners are we talking about? What kind of deals are we expecting?
Yeah, hey, Matt. So there's big questions here about exactly what would also comprise a deal, since we know that this administration is really pushing forward that they're looking to clinch what they have called agreements of understanding. Our understanding is that would be more of a framework to work towards a larger and more long-term deal. Now, President Trump, on his way to Marine One earlier today, did say that there was good progress when it comes to talks with Japan. We know, of course, Japan has been prioritized in these discussions, one, because the administration says that they've reached out early and directly to President Trump, but also because it's one of those countries that's geographically close to China. And this administration is making clear they are prioritizing those countries, including India and South Korea as well, in their bid to shore up support against Xi Jinping. Now, yesterday in the Oval Office, Treasury Secretary Scott Bessent said that they also were very close to one of these framework agreements with South Korea. He said that they brought their A game, in his words, and that they were going to be working out the technical details as soon as next week on what a potential framework could look like.
Well, you bring up Treasury Secretary Scott Bessent, and we know that he is playing a leading role specifically in talks with Japan. I want to go back and revisit something that he floated a couple weeks ago, this strategy that basically the U.S. is going to seek to reach trade agreements with a bunch of different countries and then approach China as a group, because it seems like that strategy is falling apart a little bit here. We know that Bloomberg reported yesterday that Japan, even though apparently they're getting close to a deal, is going to resist efforts to form a trade bloc against China. We know that the EU and China are speaking right now. So where do we stand on that sort of approach?
Right, exactly. And that reporting from Bloomberg News saying that Japan is really going to push forward if the U.S. ends up asking them to curb their own trade against China. And that could look like a few different things. Some of the proposals floated, including asking countries not to absorb excess goods that are going to be flowing into the market, as just one prime example, as this administration really does try to, as Scott Bessent said, form that bloc and then approach China together as a group. But at the moment, it appears that China is trying to shore up its own support, right? Xi Jinping had his own Southeast Asia tour the other week where he met directly with leaders, including in Vietnam and Cambodia, while at the same time, it doesn't quite appear, or perhaps there's ambiguity on whether or not he has called President Trump directly and spoken to President Trump directly. We should say in that Time magazine interview, President Trump did say that Xi Jinping has called him. He answered in the affirmative when asked directly. However, on his way to Marine One earlier today, when a reporter followed up if that call has happened since President Trump announced his tariff plans, he said he declined to comment, instead saying, quote, "I will tell you when the time is appropriate. Let's see if we can make a deal first. When it does come to that deal, we're going to have to wait and see," as the administration floats that potentially we could see some revised tariff rates in the next 2 to 3 weeks. President Trump said in the Oval Office yesterday that could also include China.
Well, let's push ahead a little bit here, Tyler, and talk about what could happen this weekend, because we know that the president is traveling to Rome for the Pope's funeral. We know that there's going to be a lot of world leaders there to pay their respect to the Pope as well. But could we see any headlines when it comes to potential talks that happen in Rome?
So President Trump himself said that he will be having meetings, though he declined to say exactly with who. He was asked directly if that would include anybody from China's delegation. Also, another thread we're importantly following is that Zelensky is going to be there as well. And of course, in tangent to all of this, we are talking about trade deals with Europe, but also the ongoing war with Ukraine, which was a big focus yesterday when we had Norway's prime minister here in Washington talking about the future of defense cooperation and what that could mean to ending the war, as this White House really does try to ramp up pressure for both sides to agree to a deal. So we're going to have to wait and see exactly who President Trump ends up speaking with, considering he has been the one to say that he will be directly involved in any negotiations going forward. When it comes to China, though, I'll just reiterate our Bloomberg News reporting, which is that for any potential deal, one of those preconditions that Beijing was looking for is for another point person other than President Trump to lead the talks here. What that could potentially mean for getting these talks off the ground and some more tangible progress, developments that we could learn about, really does remain to be seen. But perhaps as the administration tries to show that there is progress, as look towards next week, particularly when it comes to South Korea, and now a new headline crossing this morning about India after Vice President J.D. Vance came back, potentially we could see some firmer details.
All right, Tyler, staying on top of it all. Appreciate your reporting, as always. That is Bloomberg's Tyler Kendall joining us from D.C. Meanwhile, Apollo's chief economist Torsten Slok warning about the fallout from the trade war in a note titled that trade between China and the U.S. is collapsing. He also writes that in May, we will begin to see significant layoffs in trucking, logistics, and retail, particularly in small businesses such as your independent toy store, your independent hardware store, and your independent men's clothing store. Joining us now to discuss is Lee Klaskow. He is senior logistics analyst for Bloomberg Intelligence. Lee, you and I locked eyes in the Bloomberg pantry this morning. I said we have to have Lee on after I read this note. Give us the lay of the land when it comes to trucking, to logistics. Obviously, we have some pretty scary stuff from Torsten Slok. Is the mood music that dire?
I mean, it sounds like it's pretty doom and gloom from that. I mean, what I would say, it is pretty bad, though. That is for sure. I mean, we've been in a freight recession for a little over 2 years, so freight has been declining for quite some time. The trade war that we've seen has kind of exacerbated that, and it really delaying any sort of recovery. In the beginning of the year, we were expecting a truck rate recovery, and we were expecting contractual rates to increase by mid-high single digits. That recovery is getting pushed off. Those increases are now probably closer to low single digits to maybe mid-single digits if we're lucky. And the longer that these tariffs are on, the worse it's going to be. There were press reports the other day, Hapag-Lloyd, a huge shipping line, they noted that there were 30% less bookings out of China going into the U.S. So, that's going to ripple through the supply chain. Now, will there be mass layoffs in trucking or in rails? Rails probably not, because during the pandemic, when demand kind of went away, they furloughed a lot of employees, and then when demand snapped back really quickly, it took them a really long time to get those employees back to work, and they had to actually look for new employees because people were like, I don't want to work there anymore, I'm going to go do something else. And the trucking side...
Understandable, by the way, with rail, considering how they treat their employees, right?
It's a very good union job. They do well. And
but you can't take sick days.
Well, you could take sick days, but there's a process for that. But that being said, on the trucking side, it actually could be a net positive for the rate environment. The rates have been really negative, and some of that is because the spot market has been had excess capacity for quite some time, and it's been taking a long time to come out, and there's a lot of reasons for that. And that could accelerate, capacity coming out of the market, which would be a good thing for rates longer term. And the reality is right now where rates are, not many owner-operators that are operating in the spot market are making any money or much money at all because rates are so low right now.
So my thoughts on rail come from the strike, right? And
right.
When we learned that they would assign one guy to run the whole train and he wasn't allowed to take off when he was sick, maybe that was an exaggeration on the part of the union. In terms of trucking, it was a very desperate situation to get people to come back, to get anyone to carry the stuff from the ships, to the long-haul truckers, right? So,
during the pandemic was the best time to be a trucker.
What's it like now? Are truckers not making $100,000 a year?
No, I mean, like I said, if you work for a big company like a J.B. Hunt or a Knight Swift, you're doing fine. And a lot of those companies, they do rely on owner-operators, but they still have some of their own truck drivers, and some of that is for more dedicated routes. So if you think of Walmart hires you to always send a bunch of trucks from your distribution unit to the retail stores, those jobs are probably going to be okay. But what I would say is that you could see people in the owner-operating space or the spot market leave. And, that will have a ripple effect also at small to mid-sized carriers. But, I'm not too concerned about the ability of the large companies to, not weather the storm that could be approaching.
All right, well, we'll continue to check in with you once a week.
Please do.
In case because it does look pretty dire reading Torsten Slok's note, and you also don't sound very bullish. The industry saying they've been in a recession for a couple of years either. Lee Klaskow of Bloomberg Intelligence. We have the best research. Type BI, go on your terminal to find it. Let's get a look at the stocks moving at this hour with Bloomberg's Red Brown. He joins us also here on set and starts with consumer staple Colgate-Palmolive. The stock was up in earlier trading, but the earnings didn't look great.
But it is edging higher, like you said, and that's despite the company kind of coming out and illustrating the twofold impact of tariffs, both to the top line and bottom line. They cut their guidance for both those measures, but Wall Street's kind of getting the sense that, not as bad as expected. Only $200 million for incremental tariff costs. Some analysts are estimating that's, around 3% of their cost of goods sold. So really not a huge impact. And we think in the grand scheme of things, and just I think how bad things have been heading into earnings, there might just be a little bit of relief for that company.
Yeah, pretty much unchanged right now, which doesn't look too bad when you compare it to what's going on with Skechers. Kind of the opposite of a beat and raise quarter because they missed on sales, they pulled their annual forecast, and that's certainly becoming a trend.
Yeah, definitely. I think maybe the difference between these two companies is for Skechers is they get a lot of their shoes from China and Vietnam. So around 40% of their supplies come from those two countries, excuse me. So that is going to, have a lingering effect for a company like Skechers. They also are competing in a very competitive environment. They're trying to go up against bigger names, Adidas, Nike, things like that. I don't know if Skechers... Hoka's, of course. There's more and more names every week, it seems like. And I don't know if they're necessarily the best place to compete in a moment like this. But yeah, they're doing a lot of the same things that a lot of the companies are talking about, finding ways that they could maybe share costs with vendors, adjust their supply chains. My question is does that mean tariffs are working? I guess it remains to be seen.
All right, let's talk about T-Mobile. We had Verizon losing a ton of customers, Telephone gaining almost exactly the same amount, right? 300,000 on each side. What about T-Mobile?
T-Mobile, they actually missed on their new subscriber adds, and the shares are down, the biggest drop since 2023, excuse me. So yeah, it's really just kind of speaking to the competitive environment within mobile right now. All three companies sort of struggling and just kind of trading customers back and forth. There was a lot of churn within T-Mobile's customer base as well. They raised their prices on their base customers for the first time in 10 years. And again, I think that speaks to like the price sensitivity that we're seeing within consumers that, it's like my worst nightmare is having to change my cell phone plan.
Did you not get a new phone? Because a lot of people have run out and got a new one, worried about price increases due to tariffs.
Yeah.
You still have like the iPhone 5. What about you? Have you?
No, I haven't upgraded, no.
There you go. That narrative busting right there.
That's right. Well,
Red Brown.
Small sample size, obviously.
Great to speak with you. That is Red Brown of Bloomberg News. I just want to point out that drop in T-Mobile that you're looking at right now, down 10.4%, worst one-day drop in the shares since March 18th, 2020. Not something you want to see. Now, coming up, some companies are sticking to their heritage to help them succeed, while others may stumble when straying from their foundation. In today's Wall Street Week, we'll take a look at how some companies prosper over the decades. This is Bloomberg. All right, it's time for our Wall Street Week conversation, and today we're exploring how successful companies manage to focus on all stakeholders, from employees to clients and suppliers. Wall Street Week host David Weston reports.
Hello, class. The business school at Yale University has created a program to study what separates the companies that succeed over the long term from those that don't. Some may find the results surprising. They take us back to that notion that has become known as stakeholder capitalism, although many of the CEOs don't find it new at all.
We've interviewed more than 175 chief executive officers as to the practice of this concept of stakeholder capitalism.
John Iwata spent 35 years at IBM, where he worked closely on innovation and strategy with Sam Palmisano. He is now an executive fellow at the Yale School of Management.
One of the things we learned in these interviews is that most of the CEOs felt this wasn't really a departure or anything new. And some of them said this is sound business practice, or it's a return to sound business practice, especially if you think about the long term, leading a corporation or an enterprise for the long term. There are short-term pressures or expectations that sometimes get in the way of making investments or decisions that may not pay off for many quarters or even years. So you have to think about that. You may think about non-financial commitments to employees, to society, and those are not standardized. Those are not accepted measurements and metrics, and so those are soft or squishy. And other factors that come into play here.
Iwata learned from his CEO interviews of the challenges leaders face in trying to bring together disparate parts of the company and disparate interested parties, and the key role of purpose in weaving it all together.
CEOs, like every executive, comes up through a business or through a professional career in a vertical, finance or R&D or sales. And when they get into the CEO chair, Satya Nadella of Microsoft said it some years ago in an interview, it's then you realize just how multi-constituent or how many stakeholders the enterprise actually has. You have shareholders, you have governments, of course you have customers and employees, you have suppliers, and you have to have these relationships with all of these constituents. The question is, do you manage them piecemeal, or do we think of this more holistically? A lot of the CEOs described, sometimes they use air quotes, this management system, almost an operating system for the company that is based on common definitions of the firm. Some of them say there are 3 questions that you have to ask and answer. Why, what, and how. Why do we exist, which turns into the purpose of the company? What do we do, which is the strategy of the company? And how, and that's the culture. How are we going to show up?
You can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg.
The issue is capacity. Right. I'm doing this on a $5 million scale, and the borrowing cost to borrow ETFs, triple leveraged ETFs, is astonishing. Mm-hmm. Typically, you're looking at 10 to 20% borrowing costs per annum. But to short the short ETF, your borrowing cost is 7,000 basis points a year.
And that was Research Affiliates Chairman and Founder Rob Arnott speaking to us a little bit earlier about shorting both leveraged long and inverse ETFs. And let's keep the conversation on leveraged ETFs going with Eric Balchunas. He is Bloomberg Intelligence ETF analyst. Eric, happy Friday. Let's talk about a new product that's launching today, the Trader 2x long D-Wave Quantum ETF. It's launching. The ticker is QBTX. It's 2x leveraged exposure to one of these quantum computing stocks. And I wasn't that excited about it, but then we were talking this morning and you said that this is breaking the volatility barrier. And I want you to explain what that means.
Yeah, you know, it just reminds me when I was young, they were trying to break the speed barrier. And this is similar in that there's a lot of these ETFs that are coming out. Ever since they said you can't launch 3x ETFs, they figured out ways to get the most volatility out of 2x. So one way is to do single stocks. So obviously Tesla and NVIDIA were huge hits. So obviously people are going to keep trying. And then MicroStrategy came out, and that had broken the volatility barrier, meaning it was the most volatile, really, ticker you could buy in the United States. MicroStrategy was going to be about 250%, the double leverage one. Mm-hmm. So we're talking about 10 times the volatility S&P. Now this new D-Wave one is going to be about 500%. So it's going to be like almost 80% more volatile than the 2x MicroStrategy. So you're basically, be careful. Yeah. It's going to go up and down a lot every day. But that's the point for this crowd that really likes the volatility.
Right. Well, Eric, so you think about MicroStrategy, which has these product sets launched off of it. MicroStrategy has a market cap of $97 billion. You take a look at D-Wave, for example, it's $2 billion, which isn't nothing, but it certainly isn't that large. So could we enter into a situation if these ETFs get up to meaningful size that you could have the tail wagging the dog here?
Yeah, I call it the small pond problem. Every now and then, there's a small pond with a small ETF launched, and that small ETF gets bigger than it thought it would get. And all of a sudden, it does affect the small pond. So in this case, this stock is pretty small. If this ETF were to become a huge hit, say like $10 billion, yeah, it would definitely have an effect on the stock. I don't think this one will, I think it will get a small crowd of degens who are just into that volatility. But the ones that really take off that get billions are typically stocks that trade the most every day and people love. NVIDIA, Tesla, MicroStrategy. But the idea of being like, hey, you don't know this company, but the volatility, check this out. I think there'll be some takers. I don't see it getting too big, though. But we'll see. The small pond problem certainly is a factor here.
Hey, Eric, in terms of the Sell America trade that we've been writing so much about, how do you see that playing out in flows? We've been talking about, the sales of U.S. ETFs and especially from European and foreign investors.
Yeah, so Europeans have completely dumped U.S. stocks. They had half of their money coming in to U.S. stock ETFs last year. This year, 3%. But U.S. investors and Asia investors are continuing to buy U.S. stocks. So the Sell America, to me, is really a European story. I think it's generally a little overblown. The stock market's down 6% year to date after all of this. And the flows are strong. They broke a record in Q1. I did see a little bit of a pullback when Trump threatened Powell.
Right.
So we wrote a note saying that investors seem to be fine with tariffs, but don't mess with the Fed. Since he backtracked, I think you see the flows come back.
We all have limits. Eric, it's great to see you. Have a great weekend. That is Eric Balchunas of Bloomberg Intelligence. Tune into ETF IQ every Monday at 12 p.m. Eastern. And you can read all about the ETF industry in my weekly newsletter. It comes out Fridays around 2 p.m. Subscribe at Bloomberg.com/ETF newsletter. Matt, I assume you read religiously every week.
Absolutely. Cats and Coins is my #1 go-to, and then ETF IQ.
There you go.
And then I listen to your podcast.
Thank you.
Yeah, which is great. Money stuff.
I don't believe you for a bit, but I appreciate it. Have a great weekend, Matt Miller.
You too. Have a fantastic weekend. On Monday, Gargi Chaudhuri joins us from BlackRock, and Steve Soshnick of Interactive Brokers.